Most traders pick profit targets at random, the next round number, a fixed dollar profit, an arbitrary 1 to 3 hour multiple. Then they wonder why winning trades leave money on the table or stop out before reaching target. The fix is structural. Profit targets should be drawn from the chart itself, not from a calculator. Today, the measured move framework that derives targets from pattern geometry, the structural levels that confirm or override the measured move, and the volume tell that identifies real resistance versus decoration. Exit math matters as much as entry math, and most traders neglect it completely. Here's the framework. Three sources feed into the target. 1. Measured move, the height of the pattern, a base, triangle, or HNS projected from the breakout point. That's the geometric expectation if the pattern resolves textbook. 2. The next structural resistance above the breakout, usually a prior swing high or a horizontal that's been respected before. 3. A high volume node above the breakout from the volume profile. When the measured move, structural resistance, and volume node converge in roughly the same zone, you have a high probability target. When they diverge widely, use the closest one and tighten management. Watch this in a synthetic breakout chart. A trader enters on a base breakout at 103, sets a profit target at 105 because it's a round number. Price hits 105, stops them out at target, then continues to 125. The structural target was 18% away, not 5%. The trader captured 1/5 of the move available. Their entry was correct, their exit cost them 4 out of 5 units of profit. Random targets always leak edge this way, they're math-free guesses, not exit math. Here's the rule. The chart picks the target, not you. Project the measured move from the breakout. Identify the next structural resistance level above. Find the volume node nearest to those two. The convergence zone is your exit. If they diverge widely, take the closest one and either tighten the stop or sell partial there and let the remainder run to the next zone. The exit follows the same confluence logic as the entry, multiple independent factors agreeing. Random round numbers don't qualify. Multiples of R don't qualify. Only structural levels and pattern math earn the trade's exit. Now the structural target. Base height $7. Breakout from 103 projects to 110. But the next prior swing high is at 120, and the volume profile shows a high volume node at 121. The convergence target is 120. The trader sets that as profit target, lets price run, and exits at the actual structural level the chart was pointing to. 3 times the take of the random round number exit. Same trade, same entry, the difference is the math behind the target. Structural targets compound, random targets bleed. In real practice, mark the target zone before clicking entry. Project the measured move, mark the next structural resistance, identify the closest volume node above. If those 3 converge, that's your target. If they diverge, the closer level is the partial exit and the farther is the runner. Plan it in advance, never improvise an exit mid-trade. Improvised exits become taking profits early or holding for hope. Structural targets become consistent mechanical wins. So most profit targets are random round numbers that leak edge. Structural targets derived from measured move geometry, next level resistance, and volume nodes are the math-based exits that compound over time. Mark them before entry, never improvise mid-trade. The exit deserves as much chart work as the entry. Subscribe for the full method and trade your own plan. Education, not financial advice.